Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin, and Craig is a certified financial planner. His company is the Family Wealth Consulting Group. They're fee-only financial planners. They provide asset management services. He's been doing that for over 30 years. Congratulations.
Long time.
Oh boy. But see, now he's got the track record that he can talk to people about, so
Yep.
That's great. All right, well, for years, Craig has been working with people, building risk-managed, diversified portfolios.
Yes.
And principally, those have been securities and funds, but now he's doing more in the area of alternative investments, and so that's what we're going to talk about today, is about the role of alternative investments in a risk-managed portfolio.
Mike, I've been doing it for a long time, as you spoke about, and I want to say that you and I have been doing it for a long time. You in the CPA practice and me in the financial planning.
Okay.
But what you're doing here, Mike, in creating these Financial Insider weekly reviews that you do, is creating a real legacy with the best and the brightest in this community. So I commend you for that, and I'm proud and honored to be a part of it.
Oh, well, I'm proud and honored to have you here as my guest, and I know that we have been contributing to the financial education of our community, and I feel preserving the legacy of information in some of our best financial professionals, attorneys, and so forth, financial advisors like yourself that are in the Bay Area. And some have actually even come. I've had one guy that came all the way from Louisiana to come out and be a guest.
Wow.
Which is pretty cool.
That's great.
So anyway.
Mike and Craig's Mutual Admiration Society.
There we go.
Good.
So anyway, so with that, let's go ahead though and get into some of these questions.
So you mentioned alternative and used the word alternative.
Yes.
So in my industry, that's a not clearly defined word.
Yes.
At our firm, our planning team defines alternatives as anything but stocks or bonds.
Okay.
Which eliminates hedge funds.
Maybe we should say in savings accounts and certificates of deposit. Those aren't alternative investments.
Those are not alternative investments, no. So
okay.
What's the classic thing we think of? Well, real estate, how about managed futures, how about private equity, how about timber, that kind of thing?
Or how about private notes,
Yes, there are a number of investments we've set up for clients that include debt instruments, that's true, but they're not bonds.
Yeah. Okay. So, why should people consider making investments besides stocks and bonds in building an investment portfolio?
Because they're there. No. Using sticking with stocks and bonds means that you're only working in one asset class. So we typically divide stocks up into large cap, small cap, international, large cap, small cap, emerging markets, and I've just listed 5 asset classes of stocks.
Right.
The problem is that in the past 10 years, the stock market has gone down close to or in excess of 50% twice. So during those time frames, my clients called up and said, gee, what's going on here? What are we going to do to work with my portfolio? And my response was, then we've got too much money in the stock market. If you have 100% of your money in the stock market and it goes down by 50%, the high likelihood is that your portfolio is going to go down a lot, maybe more or less than the stock market. But if you've only got 50% of your money in the stock market, then when the stock market goes down 50%, your total portfolio is only down 25%. And that's much better to live with for many of my clients.
Right.
So we use alternatives as a volatility dampening tool. It's what I call a risk management tool. It reduces the volatility of returns of the total portfolio.
Right. Okay. So is that because stocks and real estate, or some of these alternative investments besides real estate, that they have dissimilar price movement with similar returns?
Yeah, so talk just about real estate here. We'll pick up one alternative. Um, um, the price movement of stocks, I mentioned earlier the 5 asset classes of stocks. The large cap international, large cap domestic used to be widely divergent in price movement, and recently have gotten slightly closer together. So as one goes up in price, the other goes up also, but not quite as much. And as one goes down in price movement, the other also goes down in price movement. That's not true in real estate. Mike, we've spent many decades hearing clients tell us, well, I bought a piece of real estate. And their total expectation is that piece of real estate will continue to go up in price. 10 years down the road, it'll be worth more than it is today, and 20 years from now, it'll be worth much more than it is today.
That's the way I hope. That's not what people have experienced in the last 3 years.
Yeah.
By the way, this is just to give a frame of reference. So today, June 14th, 2011. So when you watch our
so we've just been through the biggest real estate recession and stock market recession. And it turns out that while the stocks went down a lot, so did real estate.
Yes.
So they were closely correlated in price movement for a short period of time.
Yes.
But the stock market has recovered significantly, and real estate has not recovered as quickly. So that's what we call dissimilar price movement.
Yes.
And over the longest period of time, real estate has quite a bit different price movement from stocks or bonds. The advantage of mixing dissimilar price movement asset classes is that if I can mix 2 asset classes that have dissimilar price movement, I get less volatility of returns than either of those ingredients in my total portfolio. And the total portfolio increases its expected return higher than at least one of those ingredients. So we can plot all that, but if you have 2 asset classes with dissimilar price movement, when you mix them together, they come to the middle and have less volatility than both ingredients and more return than one.
Yeah, so we're going to get a more consistent return.
Yes.
And as we said before, some of our other shows, folks, they're on Financial Insider Weekly under past episodes, financialinsiderweekly.com. Anyway, but the idea is, especially when you're drawing some funds out, that by having less volatility, that your fund actually is going to be preserved better, and so you're going to get a longer use of the funds for a return during retirement. So
excellent. Yeah. So I will try and summarize that the way I say it, Mike.
Okay.
That was good.
Okay.
That the reason you want to reduce the volatility of your portfolio is maybe 3 reasons. The primary reason is because it feels good when you don't have huge volatility.
Right.
It really feels good when
you sleep a little better at night.
Everybody else is going like this and your portfolio is just kind of humming along. But just as importantly as that, economically, you get more terminal growth. So 2 portfolios with the same volatility, with the same growth rate, say 10% per year, but one has extreme volatility and the other one has lower volatility. The lower volatility portfolio is going to have the highest growth rate or terminal value. There's going to be more money in that portfolio over time. What we've been able to show in our risk-managed portfolios at the Family Wealth Consulting Group is that we get up to 50% more payout potential. So for clients who are retired, how do you maximize the amount of income that you can spend out of your portfolio? Well, build a risk-managed portfolio, something that's got lower volatility but still earns market returns.
So one of my clients is pointing out that they heard from our friend Bob Brinker. I know your favorite.
Oh.
But anyway, the rule of 4%. I mean, it's the idea that in most portfolios you can draw fairly safely about 4% a year out. And what you're saying is, by having a risk managed portfolio, instead of being able to take out 4% a year, you may be able to safely draw out 6%.
Very good. So yes, previous studies show that over the longest period of time, the S&P 500, the index called the S&P 500 stocks, large cap domestic stocks, has a return in over the longest period of time of 10%, or real close to that number. Mm-hmm. You would expect something growing at 10% to be able to, you could spend 5% out of it and still have a growing principal, but you can't. Mm-hmm. And the reason is that the S&P has too much volatility to it. Yeah. So because it has such deep valleys of returns, that it can't use market returns to recover the lost principal when it pays out income. Right. So a risk-managed portfolio, we've been able to build portfolios that have the same or greater return than the S&P 500, but because it has significantly less volatility, we're able to pay out close to 6% per year instead of 4% per year. That's a huge increase in income. Mm-hmm. 50% increase in income.
Yeah, so to be able to draw out, I mean, it's the difference. Let's say if you have $100,000, okay, that's invested. It's the difference of being able to draw out, 4,000 as opposed to 6,000.
6,000.
And then if we're talking about $1 million, then we'd be talking about 10 times those amounts. So anyway, but obviously then for retirement purposes, it makes a big difference in your standard of living.
Yeah.
Okay, why don't we talk about efficiency for a moment? Can you explain efficiency for investments and how the efficiency for real estate market compares to the efficiency for the stock market?
Sure. We typically describe the stock market, stocks that you find in like the S&P 500. We typically describe the stock market as efficient. That means that all the known information is known by everybody. There is no legal insider information. So everybody has the same information on every stock or access to that information. And to expect any one person to be able to use that information that everybody else has and know which stock to buy and when to trade it and outperform anyone else in that market is an unrealistic expectation. So in an efficient market, we see stock pickers, people who are picking stocks and timing the trades, underperforming a simple buy and hold through an index fund. Mm-hmm. We can't find managers in the stock market that consistently pick stocks and time the trades and outperform a stock market, an index. They tend to do it in spurts, and when they're not doing it, we never know whether it was luck or skill that caused the previous successes, or how do we expect future successes out of that.
But you can't